All right, well, today is Thursday, the 22nd of January. I hope everyone is doing well. Let's take a look at the interest rate markets, see what is moving rates. We saw such a nice tease last week, y'all. We got down to 6.01 actually a couple of weeks ago on the 12th of January. You have to go back to September of 2022 to find rates as low as they were. And y'all, the phone started blowing up. Folks were asking a lot of questions about refinances, and what the market gives, the market quickly takes away. So we have moved off of that, not quite a quarter of a point, but close to it, y'all. And here's some of what has moved interest rates higher. First, let's get into the numbers according to Mortgage News Daily. We are at 30-year fixed rate average, according to Mortgage News Daily, again, 6.19% today. 1 week ago, we were at 6.04% in that same survey. We were at 6.24% 30 days ago. So we are about back where we were 30 days ago, y'all, before we had seen the market drop dramatically and give us those 3.5-year lows. Here's what's moving the markets. Personal consumption expenditures, y'all, no shockers in this report, came in at 2.8% for September. It was 2.7% for October. Remember, this was a combined report due to the shutdown. We got October and November numbers. So we saw a 2.7% read in October, a 2.8% read in November. But here's what's important to note, y'all. The November read was replacing a very low number back in November of 2024. So it was going to be really hard for us to not see a significant pop higher just based on that year-over-year comparison, which is how this report comes out. We get the year-over-year read, and we had a really low number, artificially low in my view, back in 2024 of November of 2024. You look at the replacement numbers for the months to follow, y'all, for December, January, February, those were really higher numbers after the election of 2024. So I would expect that we will see this PCE far more favorable in future reports. We're not seeing huge movement in the bond market from that, y'all, but we do have some other pressures on the bond market, namely jobless claims. Keep in mind that interest rates go down when folks are pessimistic about the economy. When you have good job growth, that takes some of that fear away, that pushes more money into equities and out of the fixed income markets. That's not great for interest rates, y'all. Anything that reduces demand on fixed income securities is going to push interest rates higher as they chase those dollars. Jobless claims came in at 200,000. They were expected to come in at 212,000. Not a huge miss, but it was a miss in the right direction for the economy, but frankly in the wrong direction for interest rates. One of the reasons we see them a little bit higher. Also weighing in on that and pressuring bonds a bit, better than expected gross domestic product. The final number for Q3 of 2025 came in 4.4%, was expected to be revised to 4.3%, so a little bit better. And again, strengthen the economy, pushes money into equities far more than it does fixed income securities. Fixed income markets want that back. They want those investment dollars back. They do that by lowering the price of those fixed income securities and raising the yield paid on those fixed income securities. Those yields are our rates, which is why good news is not typically great news for interest rates. The FedWatch tool, CME FedWatch, has a 59% chance of a cut at the June 17th meeting. Y'all, that is I believe the fourth meeting of 2027, or 2026 rather. It is unlikely that we're going to see any cuts prior to that June meeting by the Fed. Frankly, the administration has built such a chasm between where they are and where the Fed is that I think the Fed would be loath to do anything that would threaten their independence. So I don't think they're going to give this president a cut because he has been so vocal in demanding it. And then you add the investigations into Chairman Powell. There's just no way this current Fed chair is going to allow for a cut to occur while he is in that chair. I know there's some politics in that. Just is what it is, y'all. And I also believe that when the administration has their choice in that chair for the June meeting, the June 17th meeting, that there's nothing that's going to stop a cut from occurring at that meeting. I'm not a fan of the politicization of the Fed, y'all. I don't like having that taken outside the realm of being driven by economics, but you could make a strong case, y'all, that the Fed hasn't been driven by pure economics in a very long time, and their very existence kind of strikes, you know my opinion on it. I would like to see a monetary supply that isn't decided by a dozen guys sitting around a table. I would rather have that to be purely market driven. That's just not the world we live in, y'all. The Fed is a reality. We're not going to see a cut prior to the June meeting. That's just where we're at. In any event, I hope this information is helpful for you and for your clients. The good news is we're within 1/4 of a point of our 4-year lows in interest rates. That is something to celebrate going into this new year as we head into the buying season of this spring. Y'all, we've got better rates than we did this time last year. That is something to celebrate and to something to act on because it's not guaranteed. So if you're sitting on the fence pondering a purchase, y'all, again, if interest rates fall through the floor after you buy something and get it bought before the market takes those prices higher, which it will, we're always happy to refinance you down the road. Hope this is helpful for you and for your clients as always. Stay blessed, stay safe. We'll talk to you next week.